Hello and welcome to Rebank. I'm your host, Will Beeson. Christian Faes is the founder and CEO of F2 Finance, a U.S. bridging lender writing loans since 2023, as well as its parent company, Faes & Co., a builder of lending businesses. More on that later. Prior to starting F2 Finance, Christian founded, ran, and ultimately IPOed LendInvest, a UK mortgage lender. Founded in 2008, LendInvest is an original fintech, having built and leveraged technology to lend more than £6 billion to individuals and property developers to date. In this conversation, we dive pretty deep into the bridging lending market, a.k.a. short-term mortgage market. Christian's goal of building a business in the US, the role of technology in lending businesses, the differences between the US, UK, Irish, and Australian markets, all countries in which Christian has real estate lending experience, the economics of different types of fintech lenders, and more. Thank you very much for joining us today. Please welcome Christian Faes. Christian Faes, welcome to Rebank.
Thanks, Will. It's great to have you here in our offices and to be doing this together.
Look, I feel like this has been a long time coming. We've probably known each other for
a long time.
At least 7-8 years back in London fintech days. And now here we are both in LA.
Yep.
And this
sunny LA.
And this is actually, I think, the first in-person podcast that I have recorded in many, many years at this point.
Wow.
Between COVID, then the new norm being online.
Yeah.
It's great to do it again in person.
It is. It's much better.
The audience will know you as the founder of LendInvest, mortgage-focused fintech in London. Started in 2008. You're now here. We're sitting in your office, new tech-enabled lending business. It's 2024. You had a successful exit with LendInvest, yet here you are back at it. Why?
I think I'm probably mad. I don't know. I mean, I think there's a number of elements to that, both personal and also seeing an opportunity or continuing to see the opportunity. I think on the personal side, it took a bit of time. When I stepped back from LendInvest, moved to the US, I spent a bit of time just thinking about what I wanted to do next, actually. And I'd done a bunch of angel investing and things that we can come on to talk about. And I guess I kind of realized that I wanted to be a builder. I love building businesses. It is kind of addictive, actually. And it's a sad addiction because it's very hard work and it's kind of, there's a lot more lows than there are highs. But I think almost because of that make the highs so much greater, that you're always sort of chasing it. So I kind of feel like from a personal perspective, I just wanted to build something again. I've always wanted to build something in the US. So I kind of felt like this was the opportunity. But then it was kind of like, what was I going to build? The firm that we're building now is kind of a culmination of the experience of building LendInvest, investing and doing different things. I think it kind of brings it together and now is an opportune time to be building this business. It's interesting you say, like 2008, it was very different starting a business then. When we started LendInvest in 2008, we were an offline business, so we didn't have any technology aspect to what we were building. Obviously, we trended towards being a very technology-driven business, but starting a business 16 years ago is very different to starting a business now. Actually, there's a lot of systems and technology and things that are available to actually expedite that process and actually, in some respects, make it easier. But obviously, everyone has access to them, so it's actually very competitive as well. So that has been interesting for me to see and a way for me to stay fit in thinking about the process of setting up a business.
All right. So in 2008, what was the opportunity that you saw? And then how is that similar or different now?
So in 2008, the opportunity was the financial crisis. So when we set up, we could see that the crisis was there. We didn't realize how bad it was going to get. So I'm a lawyer by background, had been involved in the short-term mortgage market in Australia, moved to the UK and saw that market had been decimated. So there were a number of lenders that were active in the market. They typically had one bank funding line, lost their funding lines, and those businesses just went out of business. So there was a couple that remained through that period, but most of the lenders disappeared at the time when there was most opportunity. So you had a lot of borrowers that actually wanted to borrow and capitalize on cheaper property prices and opportunities in the market. And then at the same time, you had interest rates trending towards zero. We got to zero. So you had investors that were having volatility in the stock market, all sorts of issues there, and then looking for somewhere to put their money to get a yield. And so the opportunity really was trying to match investors that were looking for yield with borrowers who were looking for capital. Very, very simple, I guess, but kind of that's the context around it. So like I said, we started as an offline business. Then as we grew that business, it was more focused on the technology, and the technology focus was really just looking at how bad the market was. And again, we're looking at the UK mortgage market where the bar was set really low in terms of tech enablement. Like the experience of getting a mortgage was a very frustrating, cumbersome, time-consuming, paper-heavy process that took on average 3 months for a borrower to get a mortgage. Just like very bad customer experience. So that was kind of the genesis of the idea, and then the sort of the building of the technology around that in due course. Now, if we look to now, I do think there's similar characteristics. Obviously, interest rates have jacked up, so you don't have investors desperately looking for a return. I think they are still looking for a return, but there's places where they can get a return that's not 0% in the bank. But the market has been disrupted. Jumping to exactly what we're doing here with the firm I'm building, the broader vision is to build a business that builds lending businesses. I think that's kind of plays on my skill set, my experience. Got it wrong a lot of times and then got it right other times. Building lending businesses, and then alongside that, build a private credit fund. Because I think actually one of the biggest challenges in building a lending business is actually not the equity capital. Raising the lending capital is the real challenge. And if you're a lender without lending capital, you're like a shop with nothing to sell. It doesn't really work. And so back to where I started in some respects here in the US, spent a lot of time looking at the market here. And we'd been looking at the market even from the LendInvest viewpoint of the US market of was it an opportunity to go in with regards to product that we offered there. So short-term mortgages, could we bring that to the US? And we decided not to, but I've always sort of had an eye on the market here. So when I came here and started looking at the market more recently, you saw that the market had been disrupted. It's a very institutionalized market here in the short-term mortgage market here. So in the UK, we call it bridging finance. In the US, it's more commonly referred to as private lending or even hard money, although no one seems to like the definition hard money for sort of slightly negative connotations to it. But it's typically 12 months or less. The borrower is typically, I describe them as a property entrepreneur. They want to buy property to rehab it. So they'll replace the bathroom, kitchens, tart it up, and then sell it on in a short period of time. And the borrowers that we'll target will be professionals at doing this. So they'll do it 5-10 times a year, and you can be their preferred financial provider and provide them capital. Now, the customer set is very much the same in the US. Obviously, you come to the US and it's like an infinitely bigger market. Like it's quite shocking how big the market is. But the borrower is essentially the same sort of person. They're corporates, but there's people behind them. And it's a very institutionalized market here in the US. So you have these big institutions that will buy the deal flow from the originators. So you'll have sort of the originators that are front-facing to the borrowers. They will sell their loans to these big institutional aggregators. And it was interesting when I came to the US and you look at the product, all of the lenders typically had the same product. You know, they would have the same minimum FICO score. They wouldn't lend to foreign nationals, or it would be in a very limited way. There are all these sorts of criteria that all of the lenders had, or typically most of the market had this criteria. And that was because the big institutions in the background, they were sort of determining the criteria. So that was one thing I thought was interesting. Well, let's try and get capital that's different to that so that we can create a product that's maybe different for borrowers. There must be a number of borrowers that sit outside that predefined box by the institutions that could still be a very interesting credit quality. And also then through this period, and why now is particularly interesting is because the securitization market has been quite disrupted. It hasn't been as open as what it was. And so the institutional appetite hasn't really been there in the same way, which has meant that a lot of the lenders in the market have been stuck for funding. So
over what time frame? So since when has this securitization market been?
Well, I mean, it's back open now. So there's been a couple of recent sort of decent or quite interesting securitizations, big ones. And actually the first publicly rated securitization in this asset class in the US was only a few weeks ago. But, you know, over the course of the last couple of years, I would say institutional appetite has been really constrained compared to what it was, say, 5 or 6 years ago. So it's kind of similar dynamics to what I saw in 2008, where you kind of funding's constrained, you've still got borrowers there wanting to transact and people looking to invest and the opportunity to match those two sides of the coin.
It seems to me, based on what you're saying, that you build lending businesses that are technology enabled or ultimately technology enabled versus tech businesses in the lending space. Can you tell me, one, if you would agree with that characterization, and two, if so, how you think about the advantages of your approach?
Yeah, so it's a good question. I think it's one of the sort of key learnings from LendInvest from that journey for me is that I think you have to be really careful in building a fintech lending business as to whether you are genuinely a technology business or whether you are more honestly a tech-enabled lending business. And I think in the vast majority of instances, the businesses are tech-enabled lending businesses. So the technology can be core, like you can operate like you're a technology business. You could be agile and nimble and all those ways of working, and it's the way of thinking of the customer and the customer journey and all the rest of it. But are you a technology business? I would argue in most instances not. And I think certainly for us, we're building LendInvest. One of my learnings is two things really it comes down to. I think is, does the technology you're building drive a true competitive advantage? Like, is it really building a moat for your business? If it is, that's great. Then go about building it. And two, is it really driving an operational efficiency in the business? And if you are, then do it. But at the same time, with that build, I think you've got to be careful of how much you're spending. If you're driving an operational efficiency, but you've got 100 engineers to do it, and you're driving an efficiency that could be done by a smaller number of heads, then that doesn't make a lot of sense and actually doesn't ultimately drive much value. So I'm much more leaning these days towards the enablement side of things. And I found it interesting between different markets. So I've operated in Australia, the UK, and Ireland as well, and now the US. In the UK, we built a lot of mortgage technology because there's not a lot of off-the-shelf systems. There's a couple that everyone knows. They're legacy systems. They're very poor experiences. They're just not good options. You come to the US, even for this sort of niche mortgage product that we're actively now in, there's maybe 10 off-the-shelf systems. And they are genuinely, I would say, technology businesses. They've got reasonable size engineering teams. They're providing quite good offerings. And I think that's just because of the size of the market, they can justify building these offerings. So
they're startups, VC-backed startups.
Yeah, they are.
Past few years.
Yeah, exactly. In the last sort of 5 or 6 years, they've sprung up and actually provide quite good offerings. So for us, I could take an off-the-shelf system and customize it and sort of build around it. And I guess just be more honest around it's tech-enabled rather than technology-driven. But ultimately, it's about driving a better outcome for the customer and ultimately for shareholders, because it's about the outcome, right? Delivering it. It's not just building technology for the sake of building it.
Yeah. Did you at LendInvest ever either consider or commercialize a B2B tech play?
It's a good question.
Your tech?
We haven't, but it's something that's been a constant discussion. LendInvest in the UK has built the best mortgage tech in the market. And I would say that pretty obviously sounds like a bold statement, but I think we could verify that and prove that to be the case. And I think it would be something that would be of interest to others, and we'll see how that evolves. But we haven't got around to it. I mean, I guess the technology is very built to our specific use case, so it is a slightly different business proposition and additional engineering to get to that point, but it may make sense.
Yeah. So you're obviously intentional about building a lending business with technology as an enabler. And in my mind, what that means is effectively you're taking risk and you're doing underwriting, and you're either providing on a proprietary basis or sourcing the capital required to actually extend loans.
Yeah.
How do you think about the pros and cons of the economics of that type of business versus the economics of a pure play tech SaaS business, these companies that you're buying technology from?
Well, that is a really interesting question. I've spoken to lots of founders about this, and I've got good friends that are founders of B2B SaaS businesses, and they find it laughable that they get a multiple of their ARR, but actually, our loan book, you could look at as ARR, but you don't get a multiple on your recurring revenues in the same way as a B2B SaaS business would. So I think the economic model for a B2B SaaS business is dramatically better than what it is for a lender. And it comes back to your question before in terms of licensing technology, because I think you do have to sort of be either a lending business or a technology business. And I think if you try and blur the two, you end up getting a valuation tied to being a lender rather than the B2B SaaS side of things, even though you may have all that technology. Right? Yeah, I think you do see it in the market a lot. And I think it's a mistake that lots of businesses have made, thinking, well, we'll be able to license it off and get the SaaS multiple, but it doesn't eventuate. And I think ultimately, and a lot of this is around the way lending businesses get valued. And certainly for us, it was a journey, because ultimately it will get valued on a multiple of profits, which is actually a very low one. And certainly the experience we had in the UK, which was, not the greatest one, is it's a hard journey trying to take a business to the public markets, because they will look around for comparables, and the comparables are going to be the banks or more traditional lenders. And they say, oh, well,
like one times book.
Exactly. Yeah. Which you're just like, hang on. But it certainly LendInvest was $100 million on technology. And it's kind of like, yeah, but you're like this bank here or XYZ lenders. And so that is quite an interesting journey to have gone through. And, I went through that, building that business. I was on the deal team when we did the IPO. It was almost a soul-destroying experience to sort of spend, at the time, 13 years building that business. You're bringing your baby to the public markets and you sit across the desk from an elderly man that is not that interested in technology, and he's a generalist and he looks at banks and mining companies and what have you, like all different things. And they're saying, well, we've built this really great technology. And he's like, yeah, but this is your profits. And if you built really great technology, it would drive your operational efficiencies and your profits would be bigger. And there's a rationale to that. Makes sense. And if you've got a balance sheet component, balance sheet necessarily equates risk. You're taking risk and that capital is at risk. And so they have to weight it accordingly with regards to the way they value those businesses. So that's an interesting journey. And, a lot of that plays into what I'm building now is that the focus is very much on the bottom line and building profitable businesses. That's the ultimate goal, not building technology and perceived value. It's really going to be about driving value and using technology where it makes sense to drive operational efficiencies and drive a competitive moat, but being realistic about what it is we're doing.
I mean, the business I hear you describing, the one that you're building now, I mean, it sounds very much like a cash flow focused business. There's both yield on the loans that are being made. And even if I step back and think about your ultimate vision, right? You talked about basically a company that builds lending companies and that has a credit fund on the side.
Yeah.
So it's yield generation on the credit fund. And then I'm sure there are fees on the actual, in this current bridging lending business.
Yeah.
Every time a loan is made, there's fee income, and then you're kind of laying off some of those loans potentially to institutional buyers on the other side. So ultimately not growing a massive balance sheet because you're laying off some of that capital, freeing up new capital to earn new fees on new loans. And therefore, that the economic outcome ultimately is one of, if things go well, stability, high cash flow, and hopefully, if you can use the technology to drive efficiency, strong profitability vis-a-vis peers, versus the pure B2B SaaS type business where, at least from what we've seen in the market over the past X number of years, often underlying profitability can be pretty low. Marginality theoretically is high, but there are high costs to building, scaling, customer acquisition, continuing to maintain, provide service, enhance the offering. And ultimately, the enterprise value of the company is X times ARR. Is that how you think about it as well?
I think you've described it well. I mean, I think the selling off the institutional capital is kind of like just worth clarifying a little bit, because that's the other thing with building lending businesses. You either have like a forward flow structure where you're not taking any risk, you kind of like pass it on to institutions, or you're a balance sheet lender. I think these days, everyone perceives the value of a business that passes off all of the risk to be much higher value. Kind of makes sense because there's less risk perhaps. But the reality is the balance sheet lender takes better economics because they are taking that risk. They get compensated for that. So I think that was the other sort of learning from LendInvest, is just really trying to construct your capital stack in a really thoughtful way, and also just trying to make sure you've got the drivers right. So you're right, it is about cash flow and it's about yield and it's about sort of making sure it falls to the bottom line, as opposed to you can get everything all off balance sheet, but then if you don't make any economics, what's the point of that as well? So I think there are ways you can construct your cap stack where you effectively have the economics of if it is on balance sheet, and you have the same sort of flexibility and ability to price and sort of develop your own underwriting and so on, without necessarily having all of the risk sitting on your balance sheet. But then you have to be very thoughtful in terms of the way you piece that together. And it's not just about quantum. You know, you look at businesses that hit huge numbers and you're like, wow, it's just such a great business. And it's like, but hang on, they don't make any money. You'd almost prefer to run a book that's smaller, but is high margin and cash generative and ultimately, hopefully, lower risk as well, which is kind of the holy grail. And I do think that is achievable. I think we're constructing that here now with the business here, F2 Finance, and with our funds. Yeah.
So when you talk about the capital structuring, so it sounds like, if I had to take a guess, that part of that for you is having this fund within the same entity, right? So it's not on the balance sheet of the lending business per se, but you have direct access to it. And then is there also a Or is the ultimate goal that there's also some sort of wholesale facility and you're, maybe senior and mezz type structure, like first loss type concepts?
Yeah, I mean, watch this space. So we're working on a number of options at the moment, and hopefully we'll have a lot to talk about in the not too distant future on that side of things. I think the fund is a core feature of our business. So I do think it works in a way that it serves investors well as well. So because we own the originator, we're so close to the credit. Like if you think about it, the usual private credit fund goes and lends to other lending businesses, or it sort of lends through intermediaries and so on. We own the origination platform. So we're very close to the credit. Our credit underwriter sits here and our fund manager sits here, and there's a very close intermingling of managing that credit. I think we're just closer to the credit. So I think that works for investors. But having our own fund allows us to work for the borrowers as well, because we don't have an institution necessarily saying, well, you can't lend to this FICO score, or you can't lend to someone from this country. We can determine our own underwriting processes and procedures to sort of serve the market and create products that we think the market wants and needs, and do it in a much more flexible way. So the fund is a key part of that. And obviously, it doesn't sit on our balance sheet, but it is balance sheet capital. We're in the early days of building that fund. We were lucky to have some good seed investors that have been very supportive with introducing more capital, and there's sort of a nice momentum there. But the reality is we've got big ambitions. So I think ultimately you do want it to become institutional and have other institutions come into that as well. And that's part of the journey of building a fintech lending business. It's kind of, and saw it with LendInvest, and I've been involved with building an Irish lending business. And that early stage lending is about developing your underwriting processes and procedures and piecing together the technology for how you're going to interface with customers and have some internal efficiencies. And then you've got some scrappy capital maybe to get started. Then it's kind of when an institution comes along, they need the business to look quite different. They want very detailed underwriting policies and procedures. They want to see a track record. They want to see a business presented in a very institutional way. And that's hard. I see a lot of founders, when I'd angel invest in fintech lending business, they just don't know what a bank needs to see, how the business needs to be presented in terms of a loan tape and all the sort of internal processes and procedures and third parties that you need to have involved in your business to be able to get institutional capital. So that's definitely where we're going to end up very quickly. And I think we've been, through the experience, we know how that looks. And I think that's part of what we want to build as a firm, like a real expertise around being able to identify a lending opportunity and then being able to expedite that journey, because you've got the lending capital. The broader vision for me is find a really smart, great founder out there that wants to lend in cannabis lending or solar panel financing or whatever it is. I'm just throwing ideas out there. They say, I know this domain. We say, well, come and build that business under our umbrella because we've got the lending capital. We can get you going very quickly. And then we've got the internal expertise around piecing the technology together and then ultimately institutionalizing the business for real scale and being able to do that in a very quick way compared to sort of taking 15, 16 years and making every wrong mistake there is, which kind of, I guess in some respects, I certainly did.
Yeah. How does the current interest rate environment impact your business?
Yeah, good question. So, typically lending businesses should make a higher margin in high interest rate environments. I think that is playing out in this market. It felt like when interest rates were zero, both in the UK, the US, maybe to a lesser extent in Ireland, it felt like products weren't necessarily being priced for risk necessarily in the right way. There was so much capital there. It's the weight of capital that is driving prices down. It's not being risk adjusted. So it feels like there's more of a normalization of that now. We're actually, I'm very close to the deal flow here with this business. Headline number might look a little bit expensive, but it's kind of like it's priced for the risk involved. So I think that's a positive thing. On the investor side, just generally, we're raising money from high net worths and through financial advisory networks and so on. It's
into the fund or
into the fund. No, into the fund. Yeah, into the fund. And people can get a decent return on treasuries now. And it's a tax efficient investment opportunity. We give them a much better return, and I'd say there's kind of a risk return profile there. But I think interest rates coming down should make our investment proposition even more interesting over time. And then I guess we'll need to watch to make sure that we're still pricing for risk at the back end there. But I don't know, the interest rate environment it's all pervasive now, isn't it?
So I appreciate that the business is very young at this point, though it sounds like active in its nascency. What is the current composition of the team? And then what's your steady state goal in terms of business people, origination, credit underwriting, technology?
So we're a small team at the moment. I think another learning, I guess, is I want to keep it small as long as possible. Having previously had business with hundreds of people, and it does become a real challenge to manage. So ideally attract really good people and have a smaller, leaner team. Crosses the functions at the moment: fund manager, fund capital raiser, underwriting, loan origination, and then accounting and financial controller. Small team. And as that grows, I think it's kind of more heads to that. As it balances, as we get more capital in, we need to sort of get more people on the origination side and more people on the capital inflow side. Outsourced technology at the moment with some contractors, but in due course, I would like to build an engineering team in-house, despite everything I've said before. Still see things would be like, I feel like we could build that. And it'd be quite surgical in terms of like, we could build something there that would move the needle and maybe wouldn't take that long and be that expensive from engineering time. So want to sort of get more involved in that. Obviously dealing with a remote world now, so people don't want to come to the office, which frustrates the hell out of me.
Because you're building an office-based business.
I am, but with some flexibility creeping into it, frustratingly. We're based in Santa Monica here. You can see the office is a nice setup, but if I throw a 10-mile radius around this office, am I going to get the best people in the world for this business? Maybe not, certainly for certain functions. So I think it makes sense to have a bit of open-mindedness around how that works. In due course, as that lending business ramps up, I think we would have an office that's not based in Santa Monica. I think we can move that to a much lower headcount cost in another part probably of the US. And I've seen other businesses do that, and that makes sense. But again, sort of depending how much the technology can drive efficiencies there as well. But yeah, that's kind of the new world we live in.
Talk about the office-focused approach. I don't disagree. I think there is tremendous value of time spent together in person.
Yeah, I mean, I just think for me as a startup, there's just so much stuff that needs to be communicated and just like this fluid environment of communication. I mean, we could change our strategy within a day, and it's just because we're bouncing ideas around across the desk. Not the whole business strategy, obviously, but certain things. And that's part of being able to, you need to move quickly and be nimble and agile as a startup. And that's definitely the business we want to be. And I think you can just do that much better in an in-person environment. I think ultimately you get the best out of people if they are able to feed off each other. There's a good energy. And I think, previously with LendInvest, one of the core successes of that business was its culture. People loved working there. We've still got people that work there now, 15 years later, that have done well for themselves and they've progressed in their career and they've had a great journey and they've been along with it.
This must be some of the longest standing employees at any fintech on the planet.
It's amazing. Yeah. And, and where they're literally part of family, WhatsApp with them all the time. We talk about different things. I mean, it's kind of, there's a real close relationship there. And I think you can only really build that in an office. It's different. I think times have moved on. I'm finding LA's interesting. Like there's not the same drinking culture here as there is in London, certainly. So, your office drinks and stuff was kind of like a very regular thing. And maybe that's part of the social bonding and so on. But people do different things here. You go for a run or you go for a walk and enjoy the outdoors and do that sort of stuff together. So I'm more lean towards being in the office, but also I am open-minded that, we want to build a world-class business and maybe that doesn't require everyone to actually be here every day.
You talked early on about having wanted to build a business in the US.
Yeah.
And then I think I heard you say something about the size of the US market, presumably as being one characteristic. Can you talk more about that? Or were there other reasons that you wanted to build in the US? And what's the experience been like compared to the UK and other countries?
It's been interesting for sure. I guess wanting to build in the US, I've spent a lot of time in the US over the years. We had a holiday house here and we'd come to the US a lot. And I guess just fascinated by the size of the US and the culture of the commercial capitalist kind of way that's here. That's very pervasive as an outsider when you come here. And I guess building LendInvest, I still have a bit of a chip on my shoulder. I kind of had always said to my wife, if I'd built this in the US, it'd be so much bloody bigger, rah, rah, rah. And it's kind of like, well, you can't sit in the UK and be saying that. You need to go and do it. You got to prove that is the case. So I found myself here and excited by that. In terms of the differences, it is a very competitive market. So it's a big market, but it's very competitive. People are very sophisticated in the way they go about things. And I think there's a real sales culture. It's quite inspiring actually to watch how people go about things. you don't come into this market and set up a website and have business come in the door. You know, you have to really go out and fight the fight to bring it in. So that's been interesting to see how that works. I think that's definitely 10x what I've seen in any other market. That's taken some adjustment, but you know, you adjust very quickly and hire people in that are experienced at doing that, and they've got those ways of working and are familiar with what's required to get success. So obviously in the UK and Ireland and different, Australia was kind of the same as the US in some respects, but it's just a different legal system every state you go to. So actually, even before you set up, you know, there's a whole bunch of legal puzzle you got to put together at some cost to sort of figure out where you can lend and what licenses you need. And that's kind of a barrier to entry, but it's one you've just got to work through. So I found that different to other markets. But generally speaking, it's ultimately the size of the market, the competitiveness, and just the velocity at which things move.
In terms of how quickly deals close, or in terms of how quickly
just everything
your borrowers are rinsing and repeating?
Yeah, that. So rinse and repeating is epic here. Like, it's just crazy quick. Whilst the US is a high tax jurisdiction as a broad generalization, there's not as much friction tax. In the UK, they have stamp duty, and it's quite prohibitive to actually buy and sell a property in a lot of places. The US generally doesn't have, if it does have it, it's very minimal. So, you know, there's not the same taxes involved. So you can do this many, many times and not have issue with that. But just generally in terms of like getting things done, there is a mentality of people work weekends, they work in the evening. There's a very work hard culture here, which has always been that way, but that's interesting to see people work that way. You know, I can get a hold of lawyers or accountants or employees any time of the day, actually, and that's kind of like, that's not seen as being out of the ordinary. So the way of working here is interesting. There's only 10 holidays a year, and it seems like people are even reluctant to take them. It's different to where I've seen elsewhere.
Mm-hmm,
yeah.
Mm-hmm. So you're feeling pretty good about things at this point?
I feel good. Yeah, I feel cautiously good. I think we've gone from, certainly for the firm that I want to build, we've gone from 0 to 1, and people have different interpretations of what that means. But I think we're on our way, and that first year of grinding out a lot of the piecing together is through, and we're through that now. We've got money, we've got investors, we've got a product, we've got a good team. So yeah, I'm feeling pretty good, pretty excited about things. I mean, obviously it's still a choppy market out there, but that's good. And I'd prefer, if anything, rather the choppy market to continue while we're sort of piecing it together, so that when things back to the races, depends where you look, but you know, crypto market and stock market are back to the races, but perhaps they're leading indicators for where the rest of the market is going. So I feel really good.
The main focus now, I mean, are you at the stage where you're building track record?
Yeah.
Track record that you can leverage for greater institutional capital, basically.
Yeah. We've been lending since early last year. Mm-hmm. Yeah. In a small way, but each month is bigger. We're seeing more deal flow. We're completing more deal flow. It's a bankable track record, and it's a good track record. Yeah.
You're self-funding the business, or you have equity partners?
I am self-funding. I've got a couple of small equity investors who have been helpful, but generally self-funding it. Yeah.
And you think you can either sustain that and or reach profitability soon enough that it's less of a drag?
Yeah. I think we'll be run rate profitable this year.
Wow.
And then we'll be able to sort of reinvest that into another lending business and go from there. So I don't anticipate us needing huge amounts of external capital. Obviously, we're always open to discussions, but it's not something to spend time thinking about. It's just get to profitability and then reinvest to keep building.
Incredible. Christian, I'm excited for you. It's really great to connect again. Glad we're in the same city.
Yeah, it's awesome.
Yeah. We'll have to go on one of those runs on the beach at some point.
Indeed.
Christian Faes, thank you very much for joining us today.
Thanks, Will.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.